The notion of a failed U.S. Treasury auction was once considered highly improbable, largely due to the perceived safety net provided by the Federal Reserve's capacity to print money. However, the landscape is evolving, and recent trends in Treasury auctions paint a different picture. Data from auctions conducted in recent months showcase troubling signs, notably larger tails and dealers being left with substantial portions of the issuance. These developments highlight potential vulnerabilities in the mechanisms governing Treasury auctions, sparking concerns about the resilience of the financial system and the effectiveness of government borrowing strategies. As these indicators gain prominence, investors and policymakers alike are prompted to scrutinize the underlying dynamics shaping market demand and liquidity, raising questions about the sustainability of prevailing economic models and the need for adaptive strategies in navigating uncertain terrain. To understand why recent Treasury auction results are so concerning, it's crucial to grasp the way these auctions work. Imagine the U.S. government as a borrower seeking funds. Through the Treasury Department, it issues bonds called treasuries and holds auctions to attract lenders. These auctions work like any other. Individuals and institutions can submit bids, proposing an interest rate at which they're willing to lend money to the government. The government starts by accepting the lowest interest rates offered and works its way up until it gathers enough money to meet its borrowing needs. The catch is that everyone who participates in that auction ultimately receives the same interest rate, the high yield, which is the rate offered by the last lender whose bid was accepted. This means if the government wants to borrow $1 billion and the last lender offers a higher interest rate than desired, everyone in that auction will receive the higher rate. The difference between the government's initial target rate and the final high yield is called the tail. A large tail signifies problems within the auction itself and the broader financial system. Recent Treasury auctions have shown signs of strain, and several factors are contributing to this. Firstly, foreign lenders are less enthusiastic about participating in these auctions compared to the past. Secondly, the Federal Reserve's quantitative tightening policy, where they aim to shrink their holdings of treasuries, further reduces demand. Finally, the government itself is borrowing more money than before. This confluence of factors weakens both the demand for treasuries and the overall liquidity in the financial system. As a result, we can expect these struggles in Treasury auctions to persist, particularly for long-term bonds, like 20 or 30-year treasuries, facing dwindling demand. Short-term borrowing through Treasury bills seems less affected for now because of a temporary surplus of cash in the financial system. However, if this excess liquidity gets drained further, it could magnify the problems in the Treasury market. The worst-case scenario would be a failed auction, where the government falls short of its borrowing target. While this would undoubtedly cause significant market disruptions and volatility, it wouldn't necessarily mean a government default. The government has a large reserve account, Treasury General Account, that it could tap into to cover the shortfall. However, this would likely trigger a return to quantitative easing, where the Federal Reserve would have to resume buying treasuries to stabilize the market. This, in turn, could lead to inflation as the government essentially prints money to finance its spending. The troubling developments in Treasury auctions point to a larger shift in the economic landscape. We may be entering a new phase of the long-term debt cycle, a cycle that typically spans decades where borrowing becomes more prevalent, fueling inflation. This environment could significantly reshape markets, potentially making traditionally safe assets less stable and reliable. The increasing instability of U.S. Treasury bonds, once considered the bedrock of safe investments, highlights this shift. Investors must adapt to this changing environment. The decades-old strategies that thrived in a falling interest rate climate may no longer be optimal. Now is the time for investors to become well-informed about the complex interplay of debt cycles, government policy, and market forces. By staying vigilant and understanding how the landscape is evolving, investors can make informed decisions, mitigate risks, and potentially turn market volatility into new opportunities.